this is the basic risk management toolbox. You know, when you get it further along, it'll go from a toolbox to a tool chest. Intermediate. Then you go to a whole garage full of tools, like Home Depot. We're going to be the Home Depot of risk management. All right, beautiful. So, risk-reward ratios, we talked briefly about it. We'll talk about it a little more in depth. Stop-loss orders. How are you going to put those in? We better do some order entry. Protective puts or call options. Yeah, that's an ironic thing, you know, really, because everyone, you know, is saying, oh, options are risky, and oh, they're risky. Everyone loses their money in options. Do you guys know that a lot of investors will use options solely for risk management? That options actually can reduce risk rather than enhance risk. Some people use options for speculation, but some people like me, man, I use options all the time to limit and manage risk, all the time. So maybe I'll even show you some trades or something like that, give you some examples. I'm in a trade right now that's one of the most conservative trades in the universe. In fact, it's the most conservative trade I think I know. It's called a caller. So maybe I'll show you an example of one of those. Maybe I won't show you the one I'm in, or then you take it as financial advice and do it. Maybe we'll find a new one. Non-correlating assets. That can be a big risk management tool. Position sizing, that can be a risk management tool. So those are in our toolbox, in the basic box. You know, then we move on to delta hedging, you know, delta neutral trading, stuff like that, rebalancing, stuff like that. Very cool. So let's talk about risk-reward ratios. So in the last session, remember, if you remember, we talked about this idea of setting a target, right? And setting an entry, right? And then setting, what was it, an exit. Remember those 3 points right here? And that way we had two scenarios that could happen, you know, basically. Let's say it goes up and hits the target. Well, that's wonderful. Let's say it goes down and hits the exit. Well, we control that. So this is a lot like that Titanic analogy we used, isn't it? Saying, look, we are going to make sure there's a lifeboat on here, and do this. Well, another thing is let's say our risk-reward ratio is 2 to 1 or better, 3 to 1, 4 to 1, 10 to 1, whatever it is. If we can get 2 to 1 or better, let's say we go out and we make 20 trades like this, and we don't know whether they're going to go up or down, but we flip a coin, you know, and let's say over time, if we do it enough, if you flip a coin if you flip a coin 3 times, you know, you're going to have 2 of one of the other, you know, all 3. That's all you can really have is 2 to 1 or 3. But if you flip a coin, you know, 1,000,000 times, it's going to be about 50-50. So the more you trade, the more whatever your win-loss percentage will come to bear. Casinos depend on that. Remember I talked about the roulette wheel, how they're trying to get their win-loss percentage up. So as you trade with fundamentals and technicals and good management, but mostly fundamentals and technicals, your win-loss percentage, you'd like to see it above 50%. You'd like to say, look, I 51.49 to do it. And so your winners and your losers here. In fact, with options, you win so big, cut your losses so short, you could actually, in this one, what if we did 60? We'd lose $60, right? And we make $80. So you could literally lose, you know, more than half the time if you're managing and cutting these off. Again, it's not about picking these winners so much as it's about cutting your losers, man. Let the winners run. There's no limit to how high. It hits a target, maybe it goes higher, move your exit up and lock in your profit, but let the thing run. So if we do 10 winners, we make $100, or 5 winners, we make $100, 5 losers, make 50. So this is a risk management tool to say, hey, I'm going to have a bigger upside to stuff than I'm a downside. I'm going to put the odds in my favor by trading with the trend and doing good fundamental analysis, right? Going to learn about dojis, going to learn about higher highs and higher lows, going to use MACD, going to use all these things to help my win-loss percentage get above 50% if you can. And then we're going to make sure that our winners pay us more than our losers. Very cool concept, risk-reward ratios. Well, you know, why should I use one of these exits? You know, why not just buy and hold? I'm going to make and look, you have to do what you're going to do. You know, everyone's been taught buy a stock and hold it till they die. Why do they teach you that? Think about it for a second. Two sides to every coin. Do you think they'd like to have your money for a long time? I think they would. I think they'd like to have it for 65 years if they could, because that's how they make money. It's called assets under management. So check this out. Why an exit strategy, buy and hold? Let's sell ourselves on this idea. First of all, this is a small list. I mean, we could add, Circuit City to this. We talked about Blockbuster, but there's 1.6 trillion reasons why. Right there. Delta Airlines, United Airlines. These guys, a lot of them are still in business. General Motors, they just finish, stock goes to zero. And what do? They just do another IPO, make even more money, have investors give them money again. So all the investors that put money in these, it dies. Those that like Enron, WorldCom, they're dead. But Chrysler, General Motors, Texaco, United Airlines, Delta Airlines, they're not dead. They just rebooted, but the shareholders lose everything, and then they just do another IPO, and people will say, oh, okay, we'll get in again. I'm telling you. I'm not going to hold one of these to the bottom. It's just too much money. It's too tough. So there's 1.6 trillion reasons just on the board there. And think of all the others that we could have put on if we had room. Bankruptcy, that's number one reason. I don't want to be a victim of that. And some of these are big. Lucent Technologies, if memory serves, that was one of the most, if not the most widely held stock in the world at one point. Every fund in the world had Lucent in it, man. It was huge. Every investor held Lucent, it seemed like. All kinds of guys doing this. The other thing is when a stock loses a lot of money, it can take a long time to get back to even, and there's this little mathematical glitch that you have to have. I mean, if your average growth is 6-7% a year, that can be devastating to try to come back. Look, here's the year 2000. Wham, we have the dot-com crash. Microsoft is trading up here, $51, $52. We'll call it 50. They go down here to $25 today. That's a 50% loss. But think about it. What does Microsoft stock have to do now to get back to even to its high here? It's got to double. So that's kind of a weird mathematical glitch, isn't it? You've got, or it's not a glitch, it's a phenomenon. You lose half, you got to make a run. You got to double your money to make a run. How often do stocks double? When's the last time you saw a stock double? I had one double the other day. It was called the VIX. But look at that. How often do they really double? It's easier to fall. The other thing is when they fall fast. When they rise, boy, it just takes so long to build up. Falls fast. Got to take a long time to build it up. Look at this. Fall, and it goes to get back to here. That's what, 1, 2, 3, 4, 5, 6 years. Then it falls again. 1, 2, 3. It's not even back up there yet. This is 1999 to 2011. This is 12 years. That's going from age 50 to age 62. And you're down half. Why exit strategy instead of buy and hold? That's why. Oh, we could do more. We were friendly with Microsoft. How many people in Microsoft? Everybody. How many funds are with Microsoft? S&P's got it in there. S&P 500 company. Oh, Citigroup. Citigroup falls in 2000. First, it didn't go anywhere from 2000. 1, 2, 3, 4, 5, 6, 7 years of doing nothing. And then kabam, 8, 9, 10, 11, 12 years, it's gone from 550 to 27. That's probably had some reverse splits to get the numbers. A lot of these have because they've fallen so far. Well, think about this. You're going from 550 to 28 bucks. That's 95% of the money gone. I'm not going to sit with my hands in my pockets, diversify, and hope this doesn't happen to a lot of them. I don't want to happen to any of them. Am I going to go out and buy 100 houses, and when one burns down, I say, well, at least the other, 95 worked out. At least only 5 burned down. Or would you have insurance on all of them? I think we have insurance on them all. But look at the run. Now, this gets kind of interesting. Once you get past 90%, it gets kind of crazy. Check this out. That sucker has to make an 1,800% run to get back to where it was back here for the investors. Oh, yes, there's more. How about this one? Sirius Satellite Radio, obsolescence risk. XM radio, Sirius Satellite Radio. Apple comes out with the odd pass. Killer. Boom, you're dead. What, you hire Howard Stern right here, you know, boop, that's it. That's all the power Howard's got, man. And he's on the decline. He's a little bit old, kind of passe. Howard, I don't know. I don't like Howard. So look at this. I don't know enough about Howard, but look at this. This is going from 60 to that's probably had some reverse split too. 60 to $1. That's a 98% loss. Got to make a 5,900% run to get back to even. AIG, 99% loss. Got to make 99,000. That's 10,000%. When's the last stock you had that went 10? And you know what kills me? People are buying this right now because it's trading. There are people buying this at 23. And you talk about reverse split. It wasn't at 2,000, man. It was, you know, I mean, it was what it was, but it wasn't at 82,000. That's reverse split stuff. That's a big deal. Big deal. So how long is it going to take for this to come back? And this is the trap you get into. Okay, you buy it, you know, in here, and it makes a nice run. Okay, great. Oh, well, you know, I'm even. I'm okay. Okay, I'm down a little bit. Now I'm up a little. Well, I'm just right. And then all of a sudden, well, I can't sell it now because, you know, I don't want to lose any money. And that's the trap. I can't. You get a trap mentally. I can't sell it now because well, now I really can't sell it because, I mean, I've lost everything. Well, now I have no choice but to just hold it. See how that trap goes? Without a line in the sand, without an exit strategy, you just, next thing you know, you have one of these and you feel like, well, I can't sell it now. I mean, look how much money I'd lose. And so, hey, here's a secret. The money's gone, baby. It was gone the moment this happened. It's gone. Toast. Poof. History. But people hold, hoping it will go back up. And how much control do you have to make that go up? Oh, I would say zero control to make something go up. I'd say worse than zero. So, not to belabor the point, but why exit strategy instead of buy and hold? That's why. Well, it goes on. What about your time? You know, you look, I love this Nikkei example because they have the same policy. Look, housing boom with low interest rate, right? Everyone can get a mortgage, causes demand for houses because everyone can buy one. If everyone can buy one, they buy them, big demand. Up goes real estate. Finally, it's unsustainable. It can't keep going higher and higher and higher. Then the price of the homes outpace the loans or the amounts, and boom. Look at this. You go, I mean, up and down. Golly, I wish I'd have known technical analysis when I was in high school right here. This is where I was in high school right here, man. I could have got in on this. So look at this. Boom. Down it goes. That's 27 years ago, guys. 27 years ago. And just worse and worse. Time's gone. You can't get that back. So what if a guy is diversified in the Nikkei? Well, it hasn't been like it's much different over here. I mean, we're already 10 years in. This is 27 years. This is 12 years, right? 98. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 years since 1998. We're up, what, 20%? 14% is what we're up. From 2,000 around in this area to 2,400. That's a 14% gain. What is that divided by? That's 1%, a little over 1% a year. That's not, inflation's 3% a year. So even if you get your money back, the time's gone. You know, we're going from, what's that, 13 years? We're going from 50 to 63. We're going from 63 or 60 to 73. Oh, I mean, that's long term to me. This is long term to me. 27 years to me is long term. 100 years is not long term. That's too long term. You got to have this money in 20 years, 15, 20 years. I mean, that's the NASDAQ. These are major companies. Microsoft. This is not representing one company. This is the whole. This is the technology deal. Nokia is in here. Nokia is in the Nikkei as well. So there you go. This is the S&P 500, about the same, 1% a year if you go over that 13-year period. If you go from 2000 to now, you're down. So, and it's not looking real good right here. Okay, this is looking very similar to me. If you ask me, that looks, and that looks very similar. So time's gone. So you get the message. Why do we buy and hold? Because we're dumb, I think. That's just my opinion. Talk to your fiduciary. I can't give financial advice. Hey, time can be gone forever. Okay, so if we're going to put in a stop order, okay, something that will stop us from having this happen. I don't want to buy this $100, have it at 50. So I got to draw a line in the sand. In this case, it's 90, okay? So let's talk about how this can be done. And I want to say this is, this is all woven in together because got to have technical analysis. In fact, this is just a basic class, so I'm showing basic concepts, but in reality, this wouldn't be my favorite trade. Why? Well, look at this. I got support right here and my exit here. I would like almost to have my exit below the support in case it bounces off it, right? But we'll get into some of that stuff later. So, order entry. This is a real stock. It's actually an ETF. Kind of mimics silver. Has its risks too. But here I look at the trajectory of this. I mean, there's so many things to do technically on this. Just as well do them since we're together. Is here I see a point of resistance, right? Boy, it pops above that baby, and look at that. Now the resistance becomes what? Support. So we catch this here, and up it goes. That'd have been a nice catch. And now it's come back down. We draw this trend line here, and we see it's come back down, and it hit the trend line, and it's close enough to call it a hit. So this stock, I mean, who knows what it's going to do? Maybe it hangs in here for a bit, and comes off this, and then goes. That's fine. But it's down far enough now, in my opinion, that we can put in an entry. Target of 45, absolutely realistic. Absolutely. But here's the thing. We looked at that Microsoft that went from 50 to 20. Do I want that to happen here, going from 40 to 20? No, I don't. I mean, this thing was 1750 a year ago. So do I want to be in this and just all of a sudden turn it into something I got to hold and wait for 20 years for it to come back up? I don't think I do. So I'm going to draw a line in the sand and say, look, this is it. That's all I'm going to risk in this thing. I'm not going to let half my money be gone. I'm not going to let this thing die on me. Silver's precious metal, probably wouldn't go to zero, never has. But even if it's one of these companies go bankrupt, if this is Enron, hey, if it heads down there, the chart is the bottom line. And if I let the chart get away from me, then I'm holding it like we talked about before. So we're going to enter right here. Let it take us into the stock. If it goes down, we won't be in the trade. But if it takes off, and then reverses, that's when we get out, right? So we're going to let it come up first and establish this line. Let this stock prove to us that it really takes the support line seriously that we've drawn here. So there we go. Now, target 45, realistic, reward $6. So on these right here, I like to see you have, as a beginner, just testing things out with your paper trading. Let's make sure we have $2 reward for every $1 risk. $2 or more, okay? $2 or more. This one's even better. It's got 3 to 1, right? 6 to 2, which is 3 to 1. So pretty nice trade right here. I would do that trade actually. So how do we enter this? Well, if you're trading for the first time, you'll need to learn how to put in orders. I'm going to do the long side. Short's just the same. You just flip it over. And rules are the same, so you'll be able to do both. So orders to open a long position. Well, we're going to be buying here. And, I thought I'd do the whole thing. So how you're going to put in the stop unless you know how to buy. So the first thing we're going to do is we're going to click this. Now every brokerage sets theirs up different, but it'll have basically the same components. It's a lot like driving a car. Hop in a car. It's got a steering wheel. It's got your blinkers, but the windshield wiper thing is sometimes a different place, and the radio might be a little different. So it has all the same parts. It's just you kind of get used to where things are in your car, right? Well, same thing here. It'll have all these parts, just might be in a different format. Some use, these are called radio buttons, but some use a drop down or a checkbox or whatever. So we're going to buy. It's going to have you list the quantity and the symbols. So the symbols can be SLV, and we'll buy 100 shares here or what have you. So we're going to buy some of this. Now, it's going to have a drop-down box that's going to select the type of order, okay? And this is going to be an order to open a trade. You can order to open, or you can put in an order to close a trade. Since we're just starting on this one, we're doing an entry. This is going to be order to open a trade. And it's going to give you, several. These are the 4 main types of orders. So let's explain these and why we choose the ones we do to help us with our odds and to manage our risk. So here we go. The first one we could do is called a market, and that just means buy the thing right now. Okay, If I click on market, it's not going to bring anything else up. It says buy it now. We don't want that one. Why? Well, if we buy it right now, let's get my blue. That means I'm going to buy it right here where it closed today, right? And again, I want it shooting up through this right here. If I buy it now, it could go down tomorrow, and now I'm losing money. So I only want to buy it when it hits a certain point, right? I want it bouncing up through this this area here. I want it where it is now, and then boom. I don't want to buy it at this exact point. I want it to have to go up through my my enters. Now, okay, now notice that when we click the limit order, that things change. See, on the market order, there's no additional box. But when we do a limit order, it'll put an additional field up here. It'll appear and say limit price. What this means is if I put 39 in here, that tells them that I want this at $39 or better. Now, I don't want it at 40 or 50 because that starts screwing up my risk-reward ratio, right? So a lot of people say, look, I want this at 39 or better. And this is a very common mistake because people like to shop at Walmart. They like cheap stuff. So they want to be getting a better price. Well, the problem is that if I say 39 or lower, it's 38.83 today. Does that qualify as 39 or lower? Yes, it does. So it's going to put me in now as well, too early, because it's at 39 or lower. Well, it's lower right now. It's right here. The bottom of this candle is 38.83. I don't want in yet. And besides, this is a terrible thing. If I tell them I wanted a price at 39 and lower, that's going to force me to buy stocks that are going down, isn't it? It's going to force me to buy things more likely to are going down. So this is one of the most common mistakes people make when they enter an order is they say, look, I want this price or cheaper. And it forces them to get in stocks to go in the wrong way. So they think they're really smart. I'm not going to do a market order. The reason people don't do market orders is the stock, see how it goes up and down during the day? Well, if you put it at 39, hit in market, you might get it at 39.05, 39.08. You spend 5 to 8 cents more than you want to by the time it triggers. And so, and you don't get a chance to shave spread, especially in the options market. Market orders cost you a little bit too much money. Limit orders, people think, okay, I'm not going to pay too much, but again, they're buying stocks that are going the wrong way, because 39 or lower means it could be getting lower. I don't want to have that. I want stocks getting higher as I buy them, right? So the other order I could do is a stop market. Now this is an interesting order. It's going to create another window called a stop price, or another field. So look at this. Markets have nothing additional. Limits put in a limit price, and then stop market puts in a stop price. Now, what this really means is stop, don't do anything until it hits that. And I got all confused because to me, it should be go, and it really should, but they call it stop. So what that means is don't do anything until it hits what? Until it's 39. So if it hits 39, buy it. Now again, once it hits 39, you might be at 39.05, you might be at 38.06, whatever. But I don't use those either. So here's the one we use. Now watch this. We put in a stop limit and watch what it does. You get both boxes. So let's say you say, and I just put 39 in both for this example, but it says, look, buy if it hits 39, and then buy it at 39 or better, which means what is it going to have to do? It's got to be going up, doesn't it? It's got to be going up, and then once it hits 39, boom, you got to get it right at 39, because I don't want it to go up and gap above and screw up my risk-reward ratio. So when we enter orders to buy, when we enter it to open an order, we always use a stop limit order. That's the same with shorting too. If we're opening the order, we use a stop limit order. Now, once that triggers, okay, and we're in, whoop, bam, now we're in. What do I need to have now to limit my loss and manage my risk? That's what we're talking about, managing risk. I got to have an exit order here, right? So again, if I put in a market order right then, it'll sell it right away. If I put in a limit order, it'll sell it at there or better. So what I really want to do is I want to use a stop market. Now here's why. I don't want to be picky with stop limits, because if this thing starts falling apart and it hits it, and by the time my order is ready to go, it's below 37, and I've said I want 37 or better, that's not going to do. So I use a stop market. So look, stop limit to get in, stop market to get out. Remember that, stop limit to get in, stop market to get out. At least that's the way I like to do it. I've walked you through the logic and how it works. Okay, so this is how we do it. Now there's something else we have called an OTO. An OTO means one triggers the other. So in other words, I can actually set it up to once it hits this enter, boom, it triggers this one to be set. Now as this is climbing, if something bad happens that hits here, I'm out because this is set, because one order triggered the other order. And you want to learn about those for sure. So very cool. But this is, notice my stop price is at 37. If it hits that, then I'm out. I'm out right away. So that's how to order to exit, and how you set in what, how you do this right here, get this risk reward in. So very cool stuff. Okay, let's talk about what happens though if something bad happens. And this doesn't have any, there's a little gap up right here, not a lot of, another gap up right here, not a real serious gap down here, but we can have these gaps. So let's talk a little bit about what we do if we get a gap.